Hi, Mike Flores here, co-founder of Trade Prosper. Section 2, which way does the market want to go? Defining which way the market wants to go is important to us. And it's important to us because it helps us figure out which trades we want to get into and which trades we don't want to be in. It also helps us define what our position size and risk management will be for each individual trade. Now, how will we decide which way the market wants to go? Well, our tool of choice from our trading toolbox will be the moving averages. Now, there are many types of moving averages, so what I'm going to do is break down to you the three most common types of moving averages. Let's begin. Moving averages are very simple. Basically, it's a price indicator that shows the average value of a security's price over a period of time. Now, the moving average, it's usually represented on a chart as a solid line or a dotted line. Let's talk a little bit about the three moving averages that I have up here. The three most common types of moving averages that I have up here. So we're going to start with, first we have the simple moving average. Now, the difference between the three moving averages, the major difference between them, is the weighting of the price data. So for the simple moving average, it's the most basic and it's the most used type of moving average. It's basically created by taking the series of prices and adding them together and then dividing by the total number of data points. So for example, if you're calculating a 10-day moving average, your calculation would have the 10 most recent prices with the oldest price falling off every day. The moving average will be based on the 10 most recent closes. An exponential moving average, it starts off its calculation with the simple moving average. So for example, let's continue with the 10-day period. The exponential moving average will start with the 10-day simple moving average number, and on the 11th day, it will include that day with the higher exponential weighting on that day. So what happens is over time, the older data points decrease exponentially, hence the name exponential moving average. Now, unlike the simple moving average, where the data falls off and only keeps the most recent periods, the exponential moving average keeps all of the data points in its calculation. And lastly, we have the weighted moving average. The weighted moving average is very similar to the simple moving average in that it only keeps the data points for the period chosen. So for example, let's stick with the 10-day. If you choose a 10-day weighted moving average, it would have the price of the previous 10 days only in its calculation. And it's similar to the exponential moving average in that it assigns different weightings to each day. The weighted moving average is calculated differently than the other two. Alright, so the simple moving average tends to be smoother and have fewer fakeouts than the other two. It doesn't react as fastly to market changes. Exponential moving average and the weighted moving average do react faster, but as a result, you have more false fakeouts. Okay, so now you have some background on the three most common types of moving averages and why we want to use them. Now, let me show you how we use them in the next video.